All right, welcome back. If you're a real estate investor who's ready to scale up, I mean really scale up, from a few properties to a serious portfolio, then you're in exactly the right place. We're about to break down the legal and financial structures that are frankly the difference between amateurs and pros. These are the tools that don't just protect your wealth, they actively help you grow it. So let's jump right in. You know, this is the one question that probably keeps every ambitious investor up at night. You're out there buying more properties, your net worth is climbing, but that little voice in your head knows your risk is climbing right alongside it. So how do you build a real estate empire without it becoming a fragile house of cards? That's the puzzle we're going to solve today. Because here's the thing about scaling. It's not just about adding more doors. It's about managing this tidal wave of complexity that comes with it. Every single new asset brings more paperwork, more legal exposure, and a much bigger chance that a problem with one property could poison your entire portfolio. Just imagine this for a second. You've got a slip-and-fall lawsuit over on property A. At the same time, there's a financing hiccup with property B. And to top it off, a messy tenant dispute erupts on property C. Now, without the right legal firewalls in place, those problems don't stay in their lane. No, they create a domino effect that could absolutely topple your other properties and maybe even your personal assets. And the crazy part? It's a catastrophic risk that is completely avoidable.
So, how do we build those firewalls? Well, the first tool in our arsenal is basically a financial shield. It's called a special purpose vehicle, or an SPV for short, and its entire job is to isolate and contain risk.
So what exactly is an SPV? Think of it like this. It's a separate, totally watertight legal container. You create this entity for one specific purpose, and one purpose only, to own a property or maybe a small group of properties. It's legally distinct from you and all your other assets. And that separation, well, that's where all the magic happens. The beauty of the SPV is how all the benefits start to stack up. First, you isolate the asset, which protects your main company or your personal wealth. If there's a lawsuit tied to that property, the liability stops right at the SPV's door. End of story. But it also makes your life way easier. Instead of juggling mountains of paperwork for every single property, you centralize all your due diligence and title transfers into one clean entity. And what does that mean? It means you can close deals much, much faster. And look, this isn't just a strategy for your home turf. As economist Dr. Pooyan Ghamari points out, this structure is absolutely critical for anyone investing internationally. If you set up your SPV in the right jurisdiction, you can significantly lower your tax bill. But more than that, it sends a powerful signal to global partners that you're a serious, sophisticated investor who knows the game. Okay, so the SPV is your shield, right? It protects your individual assets. But for true, long-term, generational wealth protection, you need more than a shield. You need a fortress. And that's where our second tool comes into play, the trust. This is a really important distinction, so let's break it down. The SPV is your transactional shield. It protects you on a deal-by-deal basis. The trust, on the other hand, is your generational fortress. It's designed for the long haul, for serious asset protection, estate planning, and guarding your entire portfolio from creditors. It's not an either-or choice. Think of them as two layers of armor that work together. So, what do you get inside this fortress? Well, for starters, it's your ultimate defense against lawsuits and creditors. It's also an incredibly efficient way to manage a diverse portfolio. And this is crucial. It makes succession planning seamless, which is absolutely vital for family offices or anyone trying to build a real legacy. In the kind of volatile markets we see today, a trust gives you a rock-solid foundation of stability. Okay, so here's how you put it all together for maximum effect. You use an SPV to go out and acquire a portfolio of properties. Then you place the ownership of that entire SPV inside a discretionary trust. This is brilliant because it means you appoint a trustee who has the flexibility to manage and distribute those assets based on your long-term goals, giving you an incredible combination of control and protection. So we've talked a lot about protection, which is huge. But these structures do way more than just defend your assets. They give you a powerful economic edge in the marketplace. Let's look at how this strategy actually puts you way ahead of the competition. And hey, don't just take my word for it. The market has already spoken, loud and clear. A recent survey found that a whopping 68% of institutional investors, we're talking the big money, prefer deals structured with an SPV. This isn't some niche, obscure tactic. It is the gold standard for the major players. When you use an SPV, you're speaking the language of serious capital. And why is that? Why do they love it so much? It's simple.
A well-structured SPV screams professionalism. It tells lenders, it tells potential partners that you are disciplined and that you get how to manage risk. In hyper-competitive global hubs like Dubai or London, this can be the one thing that gets your deal funded while everyone else is still waiting in line.
And get this. This structure also future-proofs your portfolio for the next massive wave in real estate finance, tokenization. Here's the simple version of how it works. Step 1, you secure the assets in an SPV. Step 2, the ownership of that SPV is then converted into digital shares, or tokens. Step 3, this allows you to sell off tiny fractions of the property, making a traditionally illiquid asset available to a huge global pool of investors. The SPV is the essential building block that makes all of this possible. All right, this all sounds pretty great in theory, right? But what is the actual quantifiable payoff? What's the bottom line? Let's get into the hard numbers and the real financial benefits of doing this. Let's start with immediate cost savings. By bundling a bunch of properties into a single SPV, you can literally slash your transaction costs. We're talking legal fees, administrative work, by up to 15%. That's an immediate return on investment, straight to your bottom line. Now let's talk about the long game. By holding your entire portfolio inside a trust, you can achieve some really significant estate tax savings, often in the range of 20 to 30%, depending on where you are. This is how you preserve wealth for the next generation. And finally, let's talk about speed to close. Investors using these structures report closing deals 10 to 15% faster. You know why? Because the lenders absolutely love them. They see these entities as bankruptcy remote, which is a fancy way of saying if your other businesses go under, this asset is safe. That lower risk for them translates directly into faster approvals for you. So the takeaway here couldn't be clearer. Structuring your investments this way is not just a defensive move. It is an offensive strategy with a measurable, data-driven return on your investment in terms of cost, taxes, and deal speed. So I'll leave you with this question to think about. As your portfolio continues to grow, have you actually built the shields and the fortresses you need to protect it? Is your wealth truly secure? And more importantly, is it structured to seize the opportunities that are right around the corner? Thanks for watching.